too big to fail is too big of a problem. At least that's according to Representative Paul Kanjorski. The Financial Services Committee member introduced legislation today that would allow U.S. regulators to dismantle firms whose size threatens the U.S. economy. And the congressman joins us now from Capitol Hill. Congressman Kanjorski, thank you very much for joining us. So talk to us here. I mean, first of all, I guess if you're talking about dismantling firms that are too big to fail, you have to define what too big to fail means. Is there such a definition in this bill?
Well, not in the bill, but it's a misnomer. We're using too big to fail because that seems to be an all-encompassing phrase. What we're really talking about is too risky for our financial stability and therefore not allowed to fail. And that's what we went through last year. It doesn't mean that size is a determinant. We have a set of criteria involved. It goes through, we look at size, we look at leverage, we look at interconnectivity, we look at an array of different activities that could be identified in the pool of perhaps the top 50 firms that could cause systemic risk. And those are the ones we're dealing with. The only thing my amendment does in this bill is that the bill moves us up and provides for authority, a resolution authority to occur when these institutions are in the throes of destruction. And that would have been very useful to stop Lehman Brothers from going down if we could have put them into a status known as resolution authority. But we move just a little ahead of that, and we say if we can do that after the fact, and that requires infusion of money, taxpayers' money, to handle these firms, why not prevent them when we see them getting into grave situations that will obviously end up in destruction, and they're disappearing or destroying, and to call on federal aid.
But why is this amendment needed? I mean, when you have either a council of regulators or a super regulator, however that structure ends up being structured, if you will, why do you even need this amendment? Won't the regulators, as it stands, just sort of take care of that sort of event?
No, because the authority granted in the underlying bill will only be when the institutions are in the roles of failure. Then they can, rather than taking them to bankruptcy, they'll have this other alternative. And that's very good, and we want to keep that in place. What we're adding on is another leg that it can move up to the council itself. They can make a conclusion of systemic risk. They can make an examination of what's involved. And then they have a plethora of things that we can do. We can restrict products. We can limit their exposure or their investments. We can do things that they don't necessarily have to fail at all and will be more competitive and safer as institutions. Only as a final resort, we do give the authority to divest of assets and the institution and split them up. But that's only a final result. The reality is, by putting this power in, more than likely it will never have to be used.
Congressman, how much pushback, if any, are you getting from the firms that might be affected by this?
From the major firms, we're getting pushback from some, but some I've talked to as late as this Monday, and they recognize that this is acceptable, it can be dealt with, and the ones that aren't raising the devil about this amendment are the ones that have really managed their exposure and their riskiness, and they're saying that they identify too. See, this is all about, there's nothing we can do. If we create a fund for riskiness, we can't possibly put enough money in there. Take an example of AIG. If AIG had totally failed in its derivative business and their counterparty positions, they would have gone down and lost $2.8 trillion. We can't ever build a fund of that size and hold it in a bank waiting for a single or a number of too large to fail institutions to draw on that fund to survive. The problem is they are so large, and why we call them too big to fail, they're so interconnected, and if they do fail, they cause a cascading of other firms, other businesses, and require the government to come in with inordinate amounts of money, and we can't really protect it against that by creating an insurance fund. The best example, FDIC is not an insurance fund for banks. It takes care of limited depositors' exposure. The owners, the creditors, and the large depositors in banks, they lose. Yes.
Congressman, unfortunately, we're out of time. Thank you very much for joining us to talk to us about this amendment. Again, that's Congressman Paul Kanjorski speaking to us from Capitol Hill. Appreciate it.
Thank you,
We'll be right back.